I'm going to show you how you can use a call debit spread screener so as to select the trades that you want to take if you'd like to use the bull call debit spread strategy. It's going to help you become more efficient and more time saving in your trading because it's going to quickly show you the different opportunities that are available out there. But before diving into this video, if at any point you find this video interesting or helpful, please consider subscribing to my channel. It's free and it helps me a lot, you can't imagine. So as I said, we're going to see this bull call debit spread screener. However, before going into it, I want to do a small reminder of what is the bull call debit spread strategy. So before going into the screener, it's completely clear and we understand what is that bull call debit spread strategy. So the bull call debit spread strategy, to make it very simple and be very clear, the profit and loss graph looks like this, and to make it, you need to buy a call and sell a call at a higher strike. As I said, you are bullish when you're using this strategy, meaning that you want the underlying, you want the stock to rise in price so you can make a profit. Let me show you an example of what is a bull call debit spread on Apple so it's completely clear for you. So right now I'm in the Tastyworks mobile app and I've chosen the underlying Apple. As you can see up there, it's written Apple. Then I have the option chain in front of me and I'm going to go, for example, for the May 21 expiration. Once I've opened the May 21 expiration, you see that I have the call column and the put column. So as I said, to build a bull call debit spread, you need to buy a call and sell a call at a higher strike. So what does that mean? For example, it means that I would, for example, buy the 130 strike and I would sell the 135 strike. One very important thing to mention about this strategy, other than the fact that you are bullish on the stock, this is pretty easy to understand, is that you are a net buyer when using the bull call debit spread. What does that mean, being a net buyer? Well, it means that you're paying a debit when opening a position using the bull call debit spread strategy. And you can see it with our example on Apple. You see that the mid price is $1.72 DB. DB stands for debit, meaning that I'm paying $1.72 for that bull call debit spread on Apple. So that's why I said that we are a net buyer when using the bull call debit spread strategy, because you're paying a debit when opening a position. And the opposite, when for example you're using a credit spread, you see that there will be written CR, that stands for credit, and that will mean that you are a net seller, meaning that you're receiving money. So that's the difference between the two. Either you're a net buyer and you're paying a debit when opening a position, or you're a net seller because you're receiving a credit when opening a position. That's the difference between the two. And as you are a net buyer, if we think about it just logically, when you buy something, when you buy a stock, ideally you want the stock to rise in price so you can sell it at a higher price and make a profit between the two. And that's exactly what it means being a net buyer. In our case, I'm paying $1.72 of debits for that bull call debit spread, meaning that I want my spread overall to rise in price so I can sell it at a higher price and make the difference in profit. That's logic. For example, as I'm paying $1.72 of debit for that bull call debit spread on Apple, if it rises in price, for example, let's say to $3, then I will be making a profit of $1.28 because the spread will have risen in price to $3, and as I've bought it to $1.72, the difference is $1.28, which is my profit on that trade. And that's exactly what it means to be a net buyer, meaning that when you're a net buyer, you want your spread to rise in price. However, this is not the only thing that you hope for. When you're a net buyer, you also hope for an implied volatility expansion. And what does that mean, an implied volatility expansion? Because that sounds very fancy, but what does it actually mean? Well, as the option prices and the implied volatility are like a mirror. If the option prices rise, then the implied volatility will rise, and if option prices get cheaper, then the implied volatility will go down too. Then we also want the implied volatility to be low when we are net buyers, so we have the potential of seeing the option prices go higher, get more expensive, and so see the implied volatility going higher. That's why when you're a net buyer, when you're using, for example, the bull call debit spread strategy, you want to ideally use it on stocks that have low implied volatility. And so as the option prices are going to increase, the implied volatility is going to increase too. That's why personally I like to use the IV percentile when judging if I want to use, for example, the bull call debit spread strategy. The IV percentile just tells me how high or how low is the implied volatility for stock based on the last 12 months. And right now you can see that at the top right hand corner you have this 16 that is like within a circle, and this refers to the IV rank, which is basically the same as the IV percentile. It's another way of calculating the same thing, of actually wanting to say the same thing. It's just another way of calculating it. And as the IV rank is at 16 right now, it means that over the past year, 16% of the time, the implied volatility has been lower than this, meaning that option prices have been cheaper than what they are right now, meaning that right now they're still quite cheap compared to what they could have been over the past year. In other words, the lower the IV percentile or the lower the IV rank when you're willing to use the bull call debit spread strategy, the better it is, because the cheaper the options that you're actually buying, so the more potential you have to see an implied volatility expansion. Alright, now that we understood this, now that like you got the picture of what is the bull call debit spread strategy, we understand what it means in terms of implied volatility, let's go to the main subject of that video, which is the bull call debit spread screener. By the way, if you're just starting out and you have a small account, I have a very good news for you. If you go into the first link of the description, you open up an account with Webull and you deposit $100, then you'll be given 2 free stocks valued each to $1,600. So if you'd like to benefit from that promotion, you should deposit $100 into an account and then you'll be given those 2 free stocks. So this is the bull call debit spread screener that I wanted to share with you today. So you'll find the link in the description of the video. Just go down and you're going to see a link, and that's going to lead you to this bull call debit spread screener. So first of all, I want to walk you through how it's made, the different columns, so you fully understand what are you actually facing right now. So as I said, this screener is completely free, and we're going to see filter by filter to see how it's made. So the first filter is the days to expiration. We see that right now the screener is looking for 60 days to 100 days to expirations. So it's going to show you trades with expirations that are between the 60 and 100 days to expiration mark. Then it's focusing on monthly expiration. Then we're also focusing on stock. And now we go, for example, into the volume and the open interest. And that's actually a very good thing, because the liquidity when you're actually placing a trade is so important, because this is going to determine not only how easily you're going to get into the trade, but also how easily you're going to get out of a trade with your profit. And you always want to trade liquid options, because if you don't, you're really going to have to face some liquidity issues. And I've talked a lot about it in several videos, and I think that liquidity is honestly one of the most important things. So here it shows that the trades that are going to be shown by the screener are going to have options that have open interest of a minimum of 500 and volumes minimum of 100, and which is really good. An open interest with a minimum of 500 for an option is really good. It's a really good minimum to have. Then we have the moneyness, meaning how in the money or how at the money it actually is. So the screener is going to show trades and options that are going to be in the money by -5% to 5%. Then we go into the probability, meaning the likelihood of the strategy breaking even. And here we're focusing on minimum 25%. And this is actually quite good, and you're going to understand why after. Then we go on to the second option, because as I said before, as you saw before, when building a bull call debit spread, you have a long leg, but you also have a short leg, meaning that you buy an option, but you also sell an option. That's why there's this 1 that you can see, and then there's the 2, because 1 refers to the long leg and 2 refers to the short leg, to the short option. And we have the same thing for the short leg as we had for the long leg. For example, we have the volume, we also have the open interest, when we also have a minimum bid price. And now that we saw the different filters and how it's actually made, how the screener is actually made, let's go on to the result part. So as you can see, all of those are the different results coming from the filters that we just saw before. And all of those lines, each and every single line, represents a potential trade that the screener is actually recommending. And let me walk you through so it's completely clear. At first, we have the symbol, the ticker. So as you can see, we find some Coca-Cola, some Facebook, Apple, Walmart. Then we have the price, which refers to the price of the stock that they're actually showing. Then we have the max profits for that trade. And remember that when you're trading options, one contract controls 100 shares. So you need to multiply that number by 100 to actually see what is the potential profit, like the real profit. For example, when you see that for a PSTH, the max profit is of $7.95. That means that it's actually a max profit of $795, because one contract controls 100 shares, so you need to multiply that by 100. Then we see the max profit in terms of percentage, meaning that this max profit in terms of percentage represents how much you could actually make based on how much you could actually lose. And this is the max profit that you could make. You could make 387% on that trade maximum. Then we have the max loss, which represents the premium that you're actually paying. Remember that when I showed you the trade on Apple, I showed you that we had a debit of, I don't remember how much we had, but this is the max loss that you can potentially have on a bull call debit spread. Your max loss is the premium that you're paying when opening the position. So in our case of that screener, the max loss would be $2.05, which actually mean $205, because as I said, you remember one contract controls 100 shares, so you need to multiply it by 100. Then we have the break-even, which refers to basically your profitability at expiration. If you go past that strike, then you're going to be profitable at expiration. And you see that when we go over break-even, it shows leg 1 strike plus the net debit. And that's a quick way to know what is your break-even on a bull call debit spread. You take the strike of your long leg and you add the net debit that you're paying, so your max loss, and it's going to give you your break-even. And you can quickly see it here in our example, so I can quickly show you that. The leg 1 strike is at 30, and the max loss, the premium that we're paying, is of $2.05. And look at the break-even, it's 32.05, which is exactly 30 plus $2.05, which makes $32.05. That's why we said that the break-even is the leg 1 strike plus the net debit that you're paying for the trade. Then we have the probability, which is the likelihood of the strategy breaking even. Then we have the expiration date, so what is the expiration that they're actually showing that trade for. Then we have the leg 1 strike, as we just talked about. Then we have the leg 1 ask, meaning that how much you're going to pay for that long leg. Then we have the leg 2 strike, which represents to the short option, and the leg 2 bid, which represents how much credit we're going to receive when selling that option. So all of those are the different columns for the bull call debit spread, and that's really an amazing screener, because look at how you could actually, for example, choose your trades. If you want to focus, first of all, on the max profit, on how much money maximum you could make, then you could, for example, filter the different trades by the max profit and focus on the trades that bring you the most money at once. So in our case, for example, you see that the best profitable trades would be, for example, on Facebook, you could make $2,125 maximum on that particular trade. However, if you'd like to focus more on the return on investment, then you could, for example, use the max profit in terms of percentage and filter all the trades by this column. So basically, you see the trades that are going to bring you the biggest return on investment. And for example, in our case, that would be a trade on Coca-Cola, where basically, in terms of max profit, you would make $659, but in terms of max profit, in terms of return on investment, you're making 724% on that trade. So you see that it's really a great return on investment. But if you want to, you could also, for example, filter the different trades by the max loss, so you don't pay a lot in terms of debit, so you don't risk a lot of money. And for example, you could make it like this, and you see that the trade where you would risk the least money would be a trade on Coca-Cola, again, where you would basically risk maximum $59. So you see that it actually can be quite useful to have those different columns, and you can filter the trades by the column that you want, so you basically have what you want to see first, what is important for you. For example, if what is important for you is the probability of profit, if you want to have more probabilities of profit, nothing prevents you from going into the screener and clicking on the column probability and filtering it like this, so you have the trades with the biggest probabilities of profit of at least breaking even first. So in our case, I clicked here and you see that the trade with the biggest probability of profit or at least breaking even is on NIO, and that's how it is, and you can really work like this. So let me show you an example of a trade that they recommend, so you can actually see how it's working and how it would make in real life. So as much as there is no wrong or good answer, because there's so many variables to take into account, I'd like to focus, for example, on the type of trades that bring the most return on investment for the money that I'm actually risking. So in our case, as you saw before, is the trade on Coca-Cola, where it would bring me $659 maximum for a return on investment of 724% maximum, max loss of $91. So let me show you that trade so it's completely clear for you. So you can see that first of all, they show the expiration May 21. So in your platform, and for example here in the Tastyworks mobile app, I'm going to go into the May 21 expiration. Then I'm going to follow their instructions. So the leg 1 strike is at 52.50. So I'm going to go into my option chain, and then I'm going to buy the 52.5 strike. Then I'm going to short you see that the leg to strike is at 60. So I'm going to short the option at the 60 strike. So I go down and then I short that. You see that I'm going to pay here at the mid price a debit of 85 cents, risking $85 at a maximum. You see that my max profit on that trade could be of $665, my max loss of $85. I have a probability POP, that means probability of profit. I have a probability of profit of 29%. So you see that it's actually quite cool to have all of those trades that are directly being suggested to you. If you don't have any inspiration, why not going into that screener and you see the different trades that there are? It's actually free, so it doesn't cost you anything, and you can just see some suggestions that could be good for you. And remember that I talked about the IV percentile and all about this implied volatility at the beginning of this video. You see here at the top right hand corner that the IV rank for Coca-Cola is at 4, meaning that the options compared to what happened in the past 12 months are actually very cheap right now. So a bull call debit spread on Coca-Cola right now using that strategy could actually be a great idea because the options are cheap and I'm not risking a lot of money. I'm risking $85 for a max profit of $665, so why not taking that trade? So you see how useful this bull call debit spread screener can be. And if you go into the left column of that website, you see that there are going to be plenty of other different screeners that they have built for the different strategies. I had made a video presenting the covered call screener. If you want to watch it, I was showing how the covered call screener was actually working, and overall I think that those screeners are absolutely great. I think they can give great suggestions if you don't have any inspiration for any trade, and you can really filter the different trades that they suggest based on what is important for you. Either it's the max profit in terms of dollars, or it's the return on investment, or for example it's the probability of profit, or it's actually your max loss. So it's actually quite useful to have all of those different possibilities because it really gives you a wide range of opportunities. I hope you enjoyed this video about this bull call debit spread screener. Personally, I think this is really an amazing tool, and even though you don't need to use it each and every single day, once in a while, if you want to have some idea of which trades they're actually suggesting, I think this tool is really doing a great work. And on top of that, it's free. So when it's free, you know, we should really not complain. Please make good and informed decisions. I'll see you in the next video, and as always, I wish you all the best.